Lawsuits filed by local governments against online travel companies, also known as OTCs, most often allege underpayment of hotel occupancy tax or sales tax arising from OTCs collecting these taxes on the wholesale rate that hotels charge them for rooms, rather than on the retail rate that OTCs ultimately charge customers. These cases disputing what constitutes the tax base often are filed against one or more OTCs, such as Priceline.com or Expedia.com, among many others. Often are class action lawsuits involving similarly situated cities and counties, or they seek class certification. And they sometimes include claims of unjust enrichment and conversion, as in the wrongful conversion of another's property or funds to one's own use. A common argument raised by OTCs in these lawsuits is that the difference between what they charge customers for rooms and what they contract to pay hotels to list the rooms is a facilitation service fee, commission, or markup that is not subject to hotel occupancy or sales taxes. In most cases, hotel occupancy taxes are imposed on hotel guests by cities, counties, and some states, like Alabama, Illinois, and Pennsylvania. In some cases, they are imposed on the gross rental receipts of the hotelier, like the Illinois Hotel Operator's Occupation Tax that applies with respect to room rentals. For this particular tax in Illinois, hoteliers can recover reimbursement from a guest in an amount equivalent to the tax imposed. Hotel occupancy taxes often go by other names, like transient occupancy tax, transient accommodations tax, and lodging tax. Typically, the taxes apply to short-term stays of less than a certain period, such as 28, 30, 90, or 180 consecutive days. In what is often called the merchant model, the OTCs pay over to the hotels the room rate they've negotiated with hotels, along with hotel occupancy taxes they've collected on the room. The hotels, in turn, remit the hotel occupancy tax to the taxing agencies involved. For OTCs, collecting hotel occupancy taxes on the lower wholesale rate is an advantage in courting customers. And this practice has drawn debate and litigation across the nation. Lawsuits filed by local governments against OTCs, who are also commonly known as room remarketers, accommodations intermediaries, and travel booking facilitators, began appearing with regularity around 2006. Hotel occupancy tax ordinances overall do not account for OTCs, and accordingly, in the majority of the dozens and dozens of cases brought by cities and counties, the OTCs have prevailed on the ground that their services reflected in the markup are outside the scope of hotel occupancy tax ordinances, or the OTCs are found not to be operators of hotels to whom the ordinances would apply. In some jurisdictions, like the District of Columbia and New York, legislation has been enacted that settles the question of which tax base applies in transactions involving OTCs and hotels by applying tax to the marked up rates OTCs charge customers for hotel rooms. In the few hotel tax cases filed against OTCs by plaintiffs who are not local governments, the legal arguments raised against the OTCs are different. One example is an Arkansas case, McAllister versus Hotels.com, brought against multiple OTCs by individuals found by the court to lack standing, meaning they were not qualified to file suit because they had not or would not suffer harm or injury. The case was filed by two Arkansas taxpayers on behalf of other Arkansas taxpayers and the state, alleging under-remittance of taxes by the OTCs in violation of the state constitution as the illegal exaction of public funds. The plaintiffs raised the standard argument that the OTCs collected taxes on the retail room rates, but only remitted tax on the wholesale rates. In 2013, the court dismissed the case, finding that the plaintiffs lacked standing. Specifically, the court found that a business that collects and remits taxes to the state is not an agent of the state. As a result, the taxes alleged to have been wrongfully withheld by the OTCs were not public funds in the state's possession, which would have given rise to an illegal exaction cause of action and confer standing upon the plaintiffs. Another example of a hotel tax case filed against OTCs by plaintiffs who were not local governments is Marshall versus Priceline.com, a Delaware case filed by customers of Priceline and LowestFare.com who alleged under-remittance of lodging taxes on the wholesale rate. Among the claims raised by the plaintiffs in this case were a breach of contract claim and a claim alleging breach of the implied covenant of good faith and fair dealing. The court found that the OTCs met their contractual obligations when on the summary of charges that customers had to accept in order to obtain a hotel reservation on bid, the OTCs occasionally overestimated the amount of taxes and retained the difference. So, given the overall landscape of hotel occupancy tax case law over recent years, what remains to be seen is, absent the enactment of federal legislation, will there be more state legislation enacted to settle this area, or will court cases continue to proceed at the same rate in courts across the country? Bernita, Ferdinand, CCH, Chicago.